How are you? I am Roberto Dari Dandy, and we will continue teaching in this new session of the Accounting for Decision Making and Control course at Blackwell Global University. In this regard, we will now move on to the last major topic of this course, which relates to the world of financial planning. Something that can be so important for a small, medium, and large companies, as well as my experience, show that there are significant weaknesses in real life in this aspect, so we will go to the PowerPoint so that we can review these aspects with some degree of detail. So we already have that page of this PowerPoint in this chapter 4 of Intro. And what are we going to talk about in this last part of the course? We are going to talk about corporate finance, some basic principles. We are going to talk about the functions of the financial manager, as well as profitability and risk. We are going to talk about some fundamentals of financial planning. We will look at an exercise there, Roberto. And a final exercise, which is the case of ideal manufacturers. I don't know if you will be able to see it completely, but at least we will provide you with certain indications to follow and analyze it. So, the first thing is this chart that is here, which I am sharing. What it does is summarize, or try to summarize, what the world of finance is. Many times, finance is understood as being all about numbers, a lot of Excel, and many calculations. Perfect, that is part of finance, of course. However, these finances need to be organized by topic, by areas that allow us to better understand what is being addressed. In that sense, this chart is a good summary of what finance is. And first we have, as you can see there, the first major concept that finance seeks, or should seek to maximize the value of FIBA. What does that mean? Well, to achieve the highest possible level of economic value of FIBA. And for that, there are three main types of decisions behind finance: investment decisions, financing decisions, and dividend decisions. What is behind each of them? Well, in investment, it is important to know what rate we will demand from those projects. What are the projected returns that we should generate from these projects? Regarding financing, what is the mix between debt and equity, for example? And what type of financing? Are we going to look for, short-term or long-term, in local currency, in dollars, euros? With what structure? 5 years, 2 years, 10 years, grace periods, guarantee. Well, a series of aspects that we are going to discuss. And finally, dividend decisions that are associated with how much to pay in dividends and in what manner. How? Because I can pay dividends with cash, or a company could buy back shares, which is something that usually happens, especially for those that are publicly traded. So these are the main areas of this financial map. Now, of all those here, the ones that are not generating work on a day-to-day basis are usually those associated with investment decisions and financing decisions. Dividends are usually a public decision. The company makes this decision once a year. Therefore, it is not about day-to-day matters. It is a decision that needs to be made, but it is not a daily decision. The day-to-day concerns are related to investment and with financing. Okay, so, in that sense, we will be discussing these topics during this session. Let's see if this, that, there is moving. It's stuck to that. Okay. So, this also needs to be clear. Like it aligns with the company's objectives, right? And financially, what many seek is to maximize the value of this company. What is another financial aspect than maximizing the present value of all the cash flows that the company will be able to receive in the future? Projecting those future cash flows and bringing them back to today using a certain interest rate, discount rate, or cost of capital. And therefore, it is the quantification of the wealth generated by the company. In other words, it is the market value. We are now talking about equity, not the company. When we talk about the company, we refer to the assets. Equity is the consolidated judgment of the company's shares, which is what the market value of the shares is. Whether working in the stock market or not, it can certainly be estimated, of course, with greater complexity. Now, what is behind all of this? Behind all of this are certain functions of the financial manager, certain functions. In particular, the planning and control of these financial resources in the short, medium, and long term. And this here implies working the year, obtaining the funds and their optimal utilization. In other words, managing the assets, liabilities, and equity of a company or an organization. Part of the fundamental work of financial management. In other words, to make it simpler or more concise, financial management is essentially the management of cash flows. In other words, what interests the financial manager is the ability to manage and oversee cash flows. The cash inflows, which are the revenues, and the cash outflows are the expenses. Now, it is important that we have, or know, certain definitions. First, liquidity. What is liquidity? It is the ability of a company to have or generate the funds that allow for timely payment of its obligations. And also the concept of profitability, which is the ability of an investment, a stock of immobilized resources, to generate funds in the future. And this is all related to investments, assets, and equity. And term, usually long-term, but it is not always the case. Now, the question is, what is the most important financial variable for a company's survival? And what is the most important financial variable for the possibility of creating wealth and increasing the wealth of the company's owners? So, there is a duality here, you see, right? We know that, in order for the company not to go bankrupt, the financial manager knows that it must maintain these levels of liquidity. 1 minute. Liquidity. But on one hand, from the perspective of the obligation to generate funds in the long term, the manager knows that they have to generate profitability from the assets. It is not explicitly stated, but that is what it implies. So, what does that mean? That a first major dilemma. Is it between assets that are liquid in a service, right? Liquidity to timely pay my obligations versus assets that are profitable but have low liquidity. So, I am going to be told, well, okay, in any company, how do I separate those assets? How much? In liquid assets. Sorry, normally, they have low returns, meaning if I have the money in a state bank account, the risk is, or should be, very low, except in some countries. Some bank accounts, I have a checking account or money market account, okay. So I have liquidity, but I don't have profitability, I have low profitability. And on the other hand, I can have profitable assets that will generate profits and cash flows in the future, but may be illiquid. Well, I don't know. I have a very special machine to produce a certain type of vests in specific colors and designs. Vests are in fashion, of course, and they will generate profitability and cash flow for me. But if that asset is very specific, it probably has a low alternative market, better than the secondary market, and that will make it quite illiquid. So, if one day I want to stop selling these vests, what I need to do is probably sell that asset. But if that asset was worth 100, I might have to sell it for 50. Or I don't know, maybe less, 40. It also depends on how depreciated it is, right? So, it is important how we manage liquid assets, primarily low yielding, with profitable assets that have low liquidity. First dilemma, to contrast these two very crucial and significant concepts of liquidity and profitability. So, there it is a bit highlighted, the same thing we were saying earlier. To make this more entertaining, more interesting, we need to incorporate another topic, right? And the other topic is that we can't just focus on liquidity and profitability, right? But also to start playing with another variable that is critical in the financial world, which is the variable of risk. So, we need to incorporate that risk factor because normally, high profitability goes hand in hand with a high associated risk. So, that makes us wonder, well, how much liquidity should I have in the company? In which project, on the other hand, do I need to invest? If we know that there is a relationship between return and risk, part of this can also be managed, for example, by having lines of credit. I have a line of credit and it is not utilized, it is very little utilized. Of course, there is room for what? To necessarily manage low liquidity. In the balances, I might have little cash and perhaps short-term investments. But the downside is that I have approved credit lines. The issue is that it becomes a bit more complex because I could have good lines today. But what happens if in 6 months the banks become more restrictive and say, no, you know what, we are going to reduce the amount of the line by half? That already causes me problems, right? If I had a line of credit for $1 million and it gets reduced to $500,000 and my activity has remained the same, I am going to have some kind of problem. So, yes, there is a substitute for maintaining liquidity in the company, cash. Another option is that they already have part of their portfolio in these types of things, in stocks, in bonds, that's fine. But it can also happen that some financial instruments lose value. If interest rates are rising, that will likely cause the bond to decrease in value as well. So, the equation is not that simple, because at the end of the day, of course, one says, look, let's invest in projects with a good expected return-risk ratio. Okay, what is it that companies have to do? Companies are created for that, right? They are not created to just have all the money in an account. But on our side, as we know we need to maintain liquidity, well, we have to somehow keep a certain minimum or essential liquidity, and this needs to be established in a policy or, along with that, perhaps maintaining certain short-term credit capabilities, which can be credit lines, mainly for specific events, or eventually a company even has credit sometimes approved for a period of time for which they pay a fee, and that means that, for example, they grant me a contingent credit that remains open for 6 months, and I will execute it as needed. So, there are ways to work with this, and here is the topic of profitability. For example, we can calculate the return on assets, the ROE or the ROA, which will also generate profits, which is nothing more than the desired result over the operational assets. And it can be broken down in turn because we can measure, for example, efficiency by price invested, which is the margin, the valued result over sales. And on the other hand, I can derive a level of sales efficiency over assets, which is called turnover. So, ultimately, if I multiply margin by turnover, which is the same as what we were looking at before, this results in an active surplus. So multiplied by 1, if this is sales over sales, we can arrive at PGU or ROE or ROA as the decomposition between margin and turnover. In other words, we can always break down any number associated with operational profitability, asset profitability, and segment it, separating it between margin and the turnover already, and that is of course an important element. So, what is this useful for? Among other things, it helps us analyze the level of operational profitability of the company. It cannot be okay. How do we improve operational profitability? We need to find ways to improve the margin on one hand and also improve turnover on the other hand, and hopefully, some factors will positively affect both margin and turnover. If I work on that, we could be thinking about increasing the company's operational profitability. So, always think of the company in terms of margin or turnover from the perspective of profitability. It's the same, it's the property of the DuPont analysis. What separates me? Write this, or it breaks down the values. And, excuse me, there's an error, where it says available current assets, corporate accounts plus existing ones, just in case, now it doesn't give you. So, well, if I, for example, see a company that has been having margin problems in recent years, well, I will look at what happens with the profit over the sales and the personal profit, and we will see how we break it down, right? This, and see where it is and where to effectively find the causes that may be generating a certain decrease. As we mentioned, in a profitability indicator. So it allows for a detailed examination of what is behind. For example, a decline in the company's operational profitability. And on the risk side, it is finally necessary to consider the risk of assets, which is the volatility of operational returns, and to understand the fundamental causes of operational risk, as well as the types of risk by industry. This can be measured, it can be quantified, so there really are no major issues associated. So, that being said, we are going to conclude with a first summary of these aspects that are important for financial management. How can the value of the company be maximized, the traditions of investment, financing, and dividends, and then what are the elements such as those we discussed earlier, liquidity, profitability, risk, and the specific elements they have. We will delve deeper into these topics in the upcoming sessions we have ahead of us. Thank you very much.